The labor market, of course, in focus as we're approaching next week's FOMC meeting, and tomorrow's jobs report could be a key piece of economic data for the Fed's future interest rate path. For more, we're bringing in Nick Timiraos, chief economics correspondent at the Wall Street Journal. Nick, it's always great to see you. And I guess tomorrow is sort of the first actual piece of hard data, or certainly the biggest, that could incorporate some of this tariff impact, right? Is that the right way to be thinking about it?
Yeah, so let's just get out of the way. I mean, the Fed is not going to cut interest rates next week, but the April employment number that we get tomorrow is still important because the Fed, the question right now is really how much hard data weakness do they have to see before they would cut? They meet again in June. There will be two payroll reports before June, so it's possible you could see two crummy numbers before the June meeting. And a lot of people think that would be a bare minimum. You would need to see that to get a June rate cut. So at least with the payroll number tomorrow, if it's bad, it keeps the door open potentially to a June cut. Though there is a lot that could happen between now and June, and it's, it almost feels like it's a year away. If it's a good number, I think it just raises the bar somewhat because you could still see more hard data weakness, but you only have that May payroll number before the June meeting. So it just, the calendar sort of gets crunched on you there.
We covered the jobs report, Nick. What about, I'm just curious to get your take on this April ISM Manufacturing reading we got to. It did remain below 50. It was sort of little change at 48.7. It was slightly above the estimate. But what'd you make of that reading?
Well, I paid closer attention to the commentary in there. They always list anonymous commentary from the purchasing managers they survey. I think there were 10 of those this time from different industries. All of them were about tariffs. You didn't see people talking about weak growth, high borrowing costs, unfavorable credit conditions. They all were focused on tariffs, the uncertainty, the difficulty, frankly, in planning for the future. So I think as it pertains to the Fed, they could face a choice here, and the choice would be between recession or stagflation. If we end up in a recession, it does not seem like the sort of thing that they are going to rush to try to preempt, because then you could be back in the stagflation scenario. So then I think the question just becomes, how bad is it? How much can the Fed cushion the hit? And you saw a whiff of stagflation in the ISM Manufacturing survey because prices paid rising, employment going down, maybe not as bad as last month, new orders not great. That's different from 2021 when all of them were going up.
Nick, and then there is this sort of political overlay, right? President Trump backed off and said, I'm not thinking about firing Jay Powell, but he then has continued sort of the rhetoric of he thinks the Fed should lower rates. Scott Bessent, the Treasury Secretary, in an interview, he didn't directly say, but sort of implied he thought that rates should be lowered here. So does that, and I know that Jay Powell is staunchly apolitical, but does it raise the specter of appearances here in that sort of hang over the Fed's decision-making process?
Yes, it does. I mean, the White House is clearly taking a point of view here on what should happen with interest rates, with some threats to back it up, threats to escalate a fight with the Fed. It's a fight that I don't think Powell would back down from if it came to that, but it's also a fight that is just not good for the Fed to have. And so it's possible they're able to just filter this out and sort of rise above the noise, but they're humans, right? They're humans. And I think this sort of thing, it forces the Fed, if they're not going to cut, they have to have a very good argument for why you're not cutting here. It could be the inflation numbers. It could be the job market is doing okay. I mean, for right now, where we are here on May 1st, 2025, I don't hear anybody really arguing that the Fed should be cutting rates right now. I think the argument really is about what's coming down the transom here, that the increase in prices will not persist beyond 2025, but the weakness in the underlying economy could actually overwhelm any inflationary impacts. And so people are really having a debate, not over whether the Fed should cut interest rates at this moment. The debate is about how quickly the Fed should move once they see that weakness in the economy. We could get into a place later where we're debating 25 versus 50. When it's time to cut, how fast do you go? I think for right now, again, back to the ISM numbers, nobody's really arguing that a 25 basis point interest rate cut would do anything to resolve the headwinds facing businesses.
To your point, Nick, though, I just want to get your take on this. Ed Yardeni recently wrote about how he says there's this dovish faction forming within the Federal Reserve Board, is I think how he put it, and how they believe the economy is more vulnerable and that the Fed should be acting sooner rather than later. I think he kind of framed it as sort of the Powell camp versus the Waller camp, and I'm just curious to get your take on that.
Well, even if you listen to Chris Waller, who publicly at least has put out the most dovish reaction function, he's saying, I don't think this will be inflationary, and therefore we can cut. And if we go into recession, we can cut more and faster than I'm anticipating right now. So, but even the most dovish policymaker, Chris Waller, is not arguing for interest rate cuts right now. Powell, I think, has adopted a position of studious neutrality. He is not saying one way or the other what they should do if they get into that situation. He's talking about a balanced approach, which is sort of monetary policy Greek, but what it means is when the unemployment rate's rising and if inflation's also rising, you look at how far each of those are from your goals, and you make a decision about which one you think will get back sooner, and you adjust policy accordingly. So it's the sort of thing where I think they will know it when they see it, but it's very hard for them to entertain these hypotheticals. Chris Waller notwithstanding, Fed officials are just not saying what they would do in that situation. And I think you see some of the disconnect right now in the market, right? The bond market is anticipating cuts. I think they've priced in 4 cuts this year. The stock market is not trading as if we're going to see the weakness that would prompt those cuts. So it's possible the bond market's right. They see economic weakness coming that the stock market doesn't. It's possible the stock market just thinks Trump is going to back down if the weakness arrives. And so nobody wants to be short here because the president could come in and change everything.
Nick, just sort of circle back around to the beginning and the jobs report. I'm curious if jobs are what you think the Fed are going to be watching most closely. Like, what's the data point that we all need to be really looking at? Not the point, but the trend of points.
Well, I think it's the labor market and inflation, which is sort of a Captain Obvious answer. But I think the question is going to be, do these tariffs, how soon do they flow through to finished goods prices, into the CPI? How much of it is absorbed into margins? And how much of that margin hit leads to less hiring? So they're looking at both sides of their mandate. I think which one shows up first could matter, because again, if you're following this balanced approach, if inflation goes up first and then the unemployment goes up, well, you do have a problem there. You have a real trade-off. If the unemployment rate goes up before you see the rise in inflation, then maybe it's easier to argue for a cut there. I still think what you're hearing from Powell is that they're certainly not going to be as preemptive as they've been in the past. But even when it comes time to cut, they may not do as much as what you would otherwise expect them to do because of the inflation situation.